perspective.
Thank you very much for having me, and good afternoon, ladies and gentlemen. It's good to be here in the South Africa space. The New Development Bank, like all multilateral development banks, have significantly raised our ambition when it comes to climate finance. So when you mention transition finance, I bring that into that umbrella concept of climate finance. So the New Development Bank have a strategy, a 5-year strategy, which has a number of 40%, 40% of all of our commitments. We do roughly between $5.5 and $6 billion per annum. 40% of that has to be devoted towards the climate agenda. And by the climate agenda, we're referring to both climate mitigation as well as climate adaptation. On the mitigation agenda, we are major financiers of renewable energy throughout the BRICS countries. We have a portfolio of approved projects in renewable energy of $5.9 billion. These are projects focused on solar, especially rooftop solar in industrial zones in China. We've got mega offshore wind projects in the Fujian province in China. We've got significant exposure to the renewable energy sector in South Africa via two-step loans we've provided to the DBSA, about $300 million, to the IDC, another facility of about $300 million. So we work through institutions in our member countries to enhance our impact. So in short, multilateral development banks have very unique, are very well positioned in the climate finance arena because we are publicly owned. We therefore focused on the public good. We are not solely focused on commercial returns as a bank. We are also, the other multilateral banks already have 50% targets. The World Bank, the IFC, who's not here, was meant to be here, the European Bank for Reconstruction Development, all of them have at least half of the exposure is focused on the climate agenda. So in short, the answer to your question is, this is how we have reconceptualized or reimagined our role as multilateral development banks. We do not just finance infrastructure, we finance infrastructure in such a manner that it contributes to the green industrial industrialization program that is taking place in all of the BRICS countries.
Thank you very much for that, Leslie. So drawing quite a close parallel there between transition finance and climate finance, I note. So Catherine, anything from your perspective, if I had to wake you up in the middle of the night and say, Catherine, what is transition finance? What would you say to us?
I think for me, transition finance is something that every bank is going to do or is doing at the moment, because we're all moving in a certain direction, which is away from what business as usual. That's what transition finance is, transitioning towards decarbonizing our economies as well as our respective balance sheets. So in a nutshell, for me, it's an activity that all banks will be engaged on and not particular to DFIs or even commercial banks.
Thanks for that, Catherine. You can pop the mic down there, we'll give it to Riaan. So that's really interesting. I enjoy that phrase, decarbonizing your balance sheet as well. So we're going to pick up on that, I think, a little bit later. Riaan, from an IDC perspective and your own personal perspectives, what would you say is this big term, transition finance?
So as a multinational development finance institution investing across the continent, we respect the different NDCs of the different countries that we invest in. So the finance required to achieve that, our net zero ambitions, would be our transitional finance that we refer to. Having my industrial development hat on, it's all not about energy provision for the decarbonization of the economy, but it's about creating new value chains. How do we through this decarbonization effort, create renewable energy value chains where we actually have a new investment opportunity to put our manufacturing sector on a new path for growth, and actually creating the jobs that is required from the losses that we will see from closure of coal mines, etc. One important aspect, which is mitigation and adaptation, is the whole issue of social inclusion. So how do we fund the vulnerable to become part of this process, the SMEs that we link into this process? So it's quite a holistic concept, and it's different for every country that we operate in. Thanks.
Thank you very much. So those were very big and very broad definitions that we were hearing. And I think you summed it up, Rian, by saying it's quite systemic in the way that we have to think about it. But Catherine, I want to round back to your comment that you were talking about decarbonizing your balance sheet. So if I had to ask you from a DBSA perspective, how does the DBSA approach transition finance? Are you looking at it on a project by project basis and you sort of evaluate it individually, perhaps as a project? And or is the DBSA thinking about it from the whole portfolio of projects that are being financed? Or is it somewhere in between all of those? So is it this project-based approach, or is it a portfolio approach that generally is the way that you look at transition finance?
Yeah, so I'll probably speak to my day job, which is that when we look at transition finance, whether it's a project, because how we look at the portfolio is we start with a project. Most of the projects we try to develop, we try to make sure that they can be developed to scale and be programmatic in nature. Which means that every project in itself has the capacity to expand and multiply. But at Project Prep Space, which is the genesis of Project Pipeline, you already start to inculcate what transition finance look like. So in terms of how you do your due diligence, how you ask yourself questions around what regulatory support is there for this transition space that you're trying to create? And then the banks collectively, the DFIs, are important from a policy development and thought leadership perspective, because we bridge the gap with government between private sector and public sector. But you also ask yourself on each project, what is the lifetime of that project? Because transition finance is not necessarily just a green project. It is about taking projects which might still be carbon intensive, but of course we've signed a just transition policy statement, which says that we will fund projects that are carbon intensive as long as there is an unambiguous, clear transition plan for that project to be either converted at some point, transformed into something greener. So the technology must be developed from day one and not later. But it's about inculcating that early and making sure that green elements are essential for bankability. So it's not mutually exclusive.
Thanks very much, Catherine. I'm going to also come back to a couple of questions I have on that response. So thanks very much. Rian, you mentioned earlier you were talking about new value chains. So perhaps a question I would have then is, if you are perhaps looking at a project from a transition finance perspective, are you actively looking for upstream finance opportunities as well as perhaps the project that is sitting in front of you for evaluation or consideration at a particular point in time?
What is quite apparent is that if you're in the development finance space, you cannot act as a banker anymore. You need to actually offer much more than a bank. You need to have quite an integrated strategic approach when you look at sectors. And therefore, we at the IDC has developed that planning component, the integrated planning of value chains. It's about program management, how you can bring partnerships together to actually manage and create specific products and programs that will enable you to deliver on it. But let me answer your question. Yes, we have, for instance, I mean, one of the key areas in for IDC is how do we localize upstream the renewable energy components, which is very difficult. How do we produce solar panels in South Africa, wind towers? How do we establish a storage value chain? And we need to look much broader. We need to look into the continent, into SADC for battery minerals, how one can process that locally. And we've just concluded one of our projects on cobalt that is now ready for bankability, that will process cobalt for the battery value chain, unfortunately to China still. But how do you then slowly forward integrate? And for instance, the battery value chain, we looked at two areas from the mineral side, but then also from the recycling and the assembly side. The middle gap of cell manufacturing is still a bit difficult. So you need to strategically position yourself. You need to put the risk capital on the table. You need to partner with the people who know what to do and then try and implement.
Thanks very much. So really interested in picking up on that concept of risk capital that's actually required, especially for some of the technological innovations that we might need going forward. So Leslie, as the relatively new kid on the block, the new development bank, what is the bank's position on financing, as Catherine was saying, some industries that are currently still quite carbon intensive? So what is your view on that as the new development bank, and perhaps going forward as well, how do you see that playing out from a transition finance perspective?
Sure. I think the first point to make is that the business model of multilateral development banks, and yeah, I'm referring to World Bank, Africa Development Bank, Asia Development Bank, ourselves and so on, is undergoing a radical change as we speak. It's undergoing radical change for a number of reasons. Firstly, we are the highest rated institutions from a credit rating perspective in the world. We are either AA, AA plus, or AAA, which means that we have the lowest cost of capital, and we therefore have a unique role to play to use that high credit worthiness, if you like, to improve the risk return profiles of projects that ordinarily would not be that attractive for a traditional investor. So what I'm saying is that MDBs are re-looking at, Riaan made reference to risk capital. We want to be able to make sure that we move away from our previous business model, which is we finance a big project. We're upgrading the Port of Durban, for example, at the moment in South Africa, or we are building the new dams in Lesotho that will provide South Africa with, and Gauteng with additional water. These are projects that we finance. The bank is the principal financier of those projects. In future, we will take much more, play much more of a catalytic role, where we are the ones who use our convening power because of our high credit rating. We use our ability to take on the riskier parts in the capital stack to enable your big institutions, your Coronation and your 91 and all your big asset managers who ordinarily would not invest in some of those projects. So what I'm saying in short is that there's a significant revision of reimagination of our role that is currently ongoing. We will and have to take on a lot more risk as we work towards this decarbonization process. And then the final point I'd like to make, we are also looking at some radical ideas, such as these banks, World Bank, ourselves, investing and, for example, buying these carbon intensive assets. We would be better public custodians. If Eskom, for example, have to sell the several power stations that are being decommissioned by the end of 2030, 2032, 2034, it would be better to have a development finance institution potentially manage that decommissioning process. So at the moment, we have very clean profiles. New Development Bank have no coal in our portfolio. But we have to look at how can we enable and facilitate the decarbonization and the just transition process in South Africa, and use our financing ability to enable the Just Energy Transition Partnership in South Africa, for example.
Thanks very much, Leslie. So I see some people furiously taking notes as you were making that last comment that you are offering to buy up some of these assets that we don't want to be stranded over time. But so a good offer there from NDB. I'm sure there's going to be lots of discussion after this session from a number of people in the audience. And I'm really excited that you are talking about how I don't think just multilaterals and bilaterals, but I think even national development banks are really starting to to rethink their role in the energy transition and in the just energy transition, Riaan, as you also mentioned a little bit earlier. So what I'd like to know, especially I think from the IDC and the DBSA, who've been around the block few more times, Leslie, than you have, as you say, relatively new and not having any fossil fuel assets on the balance sheet at the moment. So to Riaan and to Catherine, how is the IDC and the DBSA approaching transition finance from the way in which you go about it? So are you proactively going to your existing clients, your carbon intensive clients, and saying you need to transition and let's talk about this and let's come up with a plan, let's finance this? Are you actively also going to other, Riaan, as you were saying, upstream opportunities linked to some projects and going, we've got these projects, you need to come in as part of this deal? Or are you waiting for some of your clients to come to you and say, well, we know we need to transition, so can we have this conversation and let's see about how we finance it? So I'm really keen to understand, are you proactively going out there? Or are you all waiting for your clients to come to you? Catherine, you can go for it first and then followed by Riaan. Thank you.
I think because we have committed to a net zero pathway to 2050, and that's in line with our shareholder, we are compelled to do it proactively. We are unable to get through our investment committee's transactions that don't reflect that. And what's great is that obviously we've got a quite well-developed upstream model at the DBSA through Project PREP. So by the time it gets to investment committee, if we had done our jobs properly, it should actually already inculcate that. So it's proactive. And it's also proactive because unlike the NDB, who has very low cost of capital, we actually don't, because we don't get funded by shareholders. We actually have to go into the debt capital market to raise capital. And so for us, to transition and to fund our transition, we actually rely on partnerships especially our accreditation of the GCF and the GEF accreditations, which is concessional funding, long-term tenors and better interest rates than what we can offer. So as a consequence, that's how we are able to do what we do, but it means it comes with the responsibility to honor our commitments in respect of those funds as well. Thank you.
Value creation plans are developed for all our clients. So we're very actively involved because we're not security-based financier. We much more equity. We support. We take quite often equity risk in investments. So you need to be hands-on involved. We play. I mean, we are invested in very large emitters, and therefore we are working very closely with them, meaning putting project development funding into the green hydrogen initiatives, for instance, of Sasol, the green steel initiatives of our steel manufacturers, in order to see how we can solve the problem of making hydrogen commercially viable over time. And that means that you need to do a lot of feasibility work, sit and try and solve for that difference, try and see how you get other funders in. I think, for instance, there's German banks, etc., that's willing to fund the difference between fossil fuels and the hydrogen cost per kg, and package that together to actually put a solution on the table for your investee companies. So definitely proactive. If we are not looking forward, we're going to lose out on opportunities. So we in our planning initiatives, we actually need to also look at opportunities and present it to the clients as such.
Can I just add? And we work together quite a bit as a collective. We formed a CODFI forum for the local banks, and really what it is, it's how do we together fund the transition finance path. But important in that, and where we're also collaborating, I think, is on our SOEs where, you know, we have to support them. We have to support them, especially those that are intent on building their capacity again. And if I may say, for instance, Transnet and the like, I think we're working together on projects there. What we're doing is, even though it's not funding generation, when we are dealing with the value chain of energy, what is Transnet transporting in the locomotives? What are they using in terms of their own energy to transport themselves? All of that impacts how we see transition finance. So we can't take any asset or any funding to credit, even if it's not pure energy project, without having asked those questions about what does your ecosystem look like and what are your plans to transition. And we can assist you with that plan as well, even though it's a nascent journey for us as well. We are saying we're willing to partner you on that.
Thanks, Catherine. So I had another point I wanted to go to, but I'm going to stay with that last statement of yours for just a moment. So you said it's a nascent journey for yourselves as well. So something new, something we're probably all collectively learning about. So let me ask the hard question, and I may be excused as the moderator after this by the panelists, but let's see if they let me live through it. So do you think that development finance institutions have the capacity to evaluate transition plans or conceptualize transition plans? We know that you can fund the transition plan. So I'm trying to really dig around the capacities and the capabilities. Do you think you have them? And maybe if you don't think you have them to the degree that maybe is necessary, what kind of partnerships do you think you need to come up with to supplement what the internal capacities that you have when you start thinking about transition plans? So Leslie, I've let you off the hook for the last couple of minutes, so maybe we'll start with you on this one.
You know, one of the essential principles on which we work, as well as other development banks, we finance what we call country partnerships, meaning we might want to influence and shape and be part of the conversation around appropriate technology, but there has to be ownership in the country. It has to be rooted, the solutions have to be, the development path has to be a consensus local ownership model, and not us coming in with assessing the appropriateness of those plans. That is not the role that we play. And as you know, historically, MDBs have walked away from that model, during the era where MDBs impose conditions on their lending based on certain preconditions that they dictate. So the short answer is, in New Development Bank, we do not have that capability, nor do we intend to build that capability in-house. We are a financing institution in a very exclusive sense. That is our comparative advantage. We have low cost of capital, which we raise in the debt markets, and coming up with the most efficient financial structures to finance the green transition is where our value add is.
Thanks very much, Leslie. We welcome Ayan Adam from African Finance Corporation. I'm just going to finish up this round of questions, and then I'll introduce you properly and I'll loop you into the conversation as well. So maybe Riaan, your thoughts on that from a capacity perspective?
We are developing those tools in-house. I agree fully. It needs to be owned by the company, but we also need to develop and advise and bring in world best practice in order to guide them. So it's a process, a combined process, a partnership process. For instance, if we currently, I mean, we all know natural gas is big in SADC. How do you evaluate the CSG around that? And we've developed the in-house tool to measure what is the transition risk, what is the risk of potential lock-in. So we develop those in-house tools so that we at least make an informed decision when we support those investments. Yeah.
Catherine, your thoughts on this?
Yes, I think that we are not equally yoked in this area. So we have some capability, because we decided, I think as early as 2013, to embed our development, our economic development mandate on the climate finance. So we decided some time ago, but it obviously incrementally, the more we knew, the more frameworks internally we developed. But it's always a challenge also now in this market to keep the skills we have. But yes, partnerships, and I hate speaking about, advertising ourselves, but there is an organization here, the International DFI Finance Club, which is key for us as a partner in helping us access tools and information and data and best practice. And we also help them develop some of those insights and thought leadership. So we have partnerships, and that's how we've managed to tackle each challenge as it comes along.
Thanks very much for that, Catherine. I think there was a frank response by everyone, which we do appreciate that. So we're going to welcome our two other panelists as well, who were only able to join us a little bit later in this program. So to my right in the audience, to your left, is Ayan Adam from the African Finance Corporation. She is the Senior Director, and she's also the CEO of AFC Capital. And then to my left and your right, as the audience, is Mr. Christopher McLeod, who's the head of energy supply at IEC, and he's going to be giving us some input and some reflections on the issues of transition finance in just a moment. But I'm going to turn to you, Ayan, and I'm going to ask you, from an AFC perspective, how are you approaching this issue of transition finance? So what is the bank's plans? How do you go by approaching it? And some of what we were talking about is how do you deal with your assets that are maybe fossil fuel based at the moment? Do you proactively ask them to change? Do you assist them in that process? Or do you maybe wait for them to come to you? And how are they transitioning?
Thank you so much, and thanks to DBSA for really hosting this very important session. Transition for us. So I think we need to look at the narrative properly. Africa is only 4% contributors to the greenhouse gas emission, but that's significant. And a huge part of that is South Africa and Egypt. South Africa started early on the renewable move, and they were ahead of the game. And then there were some issues on offtake risk. But I think transition, it is not just energy, because 60% of that 4%, it is actually more industrialized aspects of Africa, a little bit South Africa, and a little bit Egypt, Morocco, and others. And transition is already happening at those countries' level. But I think transition has to be just, not just in terms of the rhetoric, but it has to be just in terms of the financial mechanism. And we really need in Africa partners that we can work with. It's not like we're going to come and solve your problem. South Africa in particular, have very strong institutions. So we need to get the financing to the right hands. That has not happened in this transition. So today, in the context of AFC, the way we look at transition is that first, we need to say, what are we transitioning from? We are transitioning for the countries that high stock of emissions to renewable energy in their power sector. We also are transitioning from using firewood and logging, illegal logging, to basically use that for cooking. And we need to see a lot more education and filtration of clean energy solutions for the poorest of the poor that are only able to use their forests and their mangroves, which in some cases in Africa store more than 3 to 7 times. I think there's a mangrove project in Kenya, which is like 7 times more carbon than a tree. That's the Africa transition story. But we cannot just take transition without talking about the fact that we have a warmed globe. Today, AFC is headquartered in Nigeria. 36 states in Nigeria are underwater. So we need to speak about transition with resilience. You can put all those rooftop solar in houses, but if those houses are going to be flooded, then it's not a just transition. Just transition for Africa is to look at both mitigation and adaptation. So in the context of AFC today, on the power side, we own actually the largest power assets in the continent. We own 1.4 gigawatts of renewable energy. in Djibouti, Cape Verde, small kind of islands where we were involved in the project development of those projects. We have assets in South Africa, Egypt, Senegal. We also developed some of the first hydro plants in West Africa, and that's hydropower, the Siningboro plant in Ivory Coast, one of the largest in that region. So we already have done 1.4 gigawatts of renewable energy, and we're probably gonna add another 2 to 3 gigawatts in the next 5 years. So that's on energy transition. We need to find solutions. We've done a bit of net zero industrial parks in Gabon, so we will continue to quadruple that. This year, we launched the Infrastructure Climate Resilient Fund, which is supposed to climate-proof Africa's infrastructure by looking at physical risks in the design, in the operation of infrastructure. Africa has most of Africa, 2/3 haven't been built. We have an opportunity to build them right. We need all mix of financing to really come to Africa. We are doing our bit. We need partners that partner with us to really deliver the goods. We can do scale. However, private capital is only going to institutions that are not present on the continent. So that needs to change and reverse and partner with DBSA, AFC, and these types of institutions that have been doing this for a long time, who are present in the African continent, both in finance, but also in spirit and physically. Thank you.
Thank you very much for that passionate response. And you mentioned the phrases mitigation and adaptation, as most of the panelists did as well, but you also brought up the issue of physical risks, which you now need to start thinking of in relation to climate change. And if we think about risks, Leslie, a little bit earlier, you said something which I definitely did not forget, which was that, especially as New Development Bank, you are willing to take on more risk. Now, that is one of my favorite phrases when I'm talking to financiers. So I'd like to hear, maybe you can start us off, and then I'd like to hear from each of the panelists just before we hand over to Christopher, is what do you see as the new risks that you are going to be facing as development finance institutions? Physical risks, new financial risks that you are having to grapple with as you think about transition finance going forward. So Leslie, we'll start with you. We'll then move along the road. We'll come then back to Ayan, and then Christopher, I will introduce your presentation as well.
Sure. Let me just start out by saying that, development finance institutions also work on the very basic, essential logic of finance based on a risk return model, right? In addition to risk return, we also factor in impact. In other words, we don't only look at the project through a risk return lens, how much risk do we take and how much return we make, but we also look at what is the comprehensive development impact. How many jobs are we creating? How many women are being employed on the project participation of youth, and so on and so on. So development banks have the capacity to take on more risks in projects, especially multilateral banks, because of our high credit rating. There are large numbers of projects, a huge number of sustainable investment projects for which there is no finance today. Why is there no finance? Because your biggest pools of capital, your asset management industry, for example, command more than $130 trillion of savings, pension funds money, sovereign wealth funds, insurance money, and so on. That money has to be invested for the long term, right? So a lot of that money today is invested in bonds, in fixed income instruments that generate very low yields, very low returns. Large portions of finance have been invested, for example, in euro bonds that produce negative interest rates. That money can be productively deployed into sustainable infrastructure. The reason why it's not deployed is of the perception of risk. So when I say we are looking at risk differently, what I mean is that as New Development Bank, we will take on that initial risk that the private sector is not willing to take. We would provide, for example, first loss guarantee, that if there is a loss, we will be the first the first company or bank to consume that loss, so that we protect the other commercial financiers. So the whole model has been captured in the concept of blended finance, which is now well established over the last 5, 6, 7 years. The key missing link is to scale it. So there's a lot of blended finance structures that have been put in place over the last 6-7 years, right? But it's still very small in relative terms. So our focus now going forward is to find ways to elevate and to bring, firstly, to standardize these products, because traditionally multilateral banks have provided mainly debt and equity and some guarantees. Today, what we are looking at is to make much more use of the financial instruments that can crowd in, that can mobilize more private sector finance. That's why we are talking about taking on more risk and providing more guarantees, so that we, as I said earlier on, we use our high rating to improve the projects.
Thanks for that, Leslie. So I just want to check with Rian and Catherine. Do you have something specific you'd like to add to this question? I also want to loop in Ayan, who was furiously nodding next to me and agreeing with what Leslie was saying. Nothing from your side, Rian, but Catherine, some thoughts?
I don't know if it's an appropriate comment to add, but I'm going to try and then run away. But because I was a commercial funder not too long ago. But there are two aspects for that. For me, the credit enhancement products or instruments that Leslie mentioned are extremely relevant, especially in the upstream space, for development, to crowd in catalytic funding, to make sure that these instruments are in place for capital projects. So I agree that we need to do that, quasi-equity first loss, etc. I think the other issue where I'm hoping that we'd move to at some point is how we view risk as banks, because our metrics of risk needs to start changing. I know there's Basel and there's all those other regulatory bodies that determine what risk look like for us. But in a world of transition, and if you really, really believe that we can reach our net zero targets, we need to reshape how we think about financial return and financial risk, and redefine it in terms of how it, and I'm not saying this is a development bank, but as commercial fund as well, how we define the impact dividend as a return as well. Because we are going to sit with stranded assets. We are going to close down more factories, more jobs, and there's no justice in that. The justice is in transitioning and redefining how we view financial return and financial risk.
Thanks for that, Catherine. So I think Rian's not going to add anything this round, but Ayan, you were nodding and agreeing with a couple of points. So just maybe in a minute, and then we'll invite Christopher, who's going to present. So Christopher, I don't know if you want to, maybe just before Ayan responds, if you'd like to get yourself set up over there and they can get the presentation rolling so long, that'll give Ayan time to respond.
So I fully agree with both comments, because yes, we do need to, the bulk of money is in private world. That's a fact. So I do fully agree that de-risking means that we support first loss structures so that we can mobilize the amount of money that is in both the African capital market. We have $1 trillion of pension industry today, but also global capital markets. So I fully agree with that, but we need to get that de-risking to the right institutions that are really on the ground. I think that's at the core of this. I also agree that we have not done enough in the context of South Africa, especially, to support the cost of this transition. We are going to lose so many jobs. It's going to be significant amount of instability socially, economically, and this is the poorest of the poor. There has to be retraining, more of the grant funding to go for this transition. So we have not seen that kind of money in my understanding of how do you transition from coal when you have X millions of your people. And it's not just the person that works there. That person supports 5 other people. And so we're talking about a lot of people that are going to be impacted. So for this type of transition to happen, we also need to think about livelihoods, sustainable development. Economically, what does it mean? Because in the US, we're saying, okay, you can't touch the coal industry, but you need to transition here. So we need to be honest about the support that's needed for an industry that employs a huge part of the population, what it means for the transition, what hand holding is needed. How do you make people better off? Because it takes a while for a new industry to develop. So in that context, I fully agree that we need to look at the livelihood as the core of the climate justice arena. Without that, I think you're going to have many frustrated people who are not able to eat. So what are you transitioning from? Thank you.
Thank you very much for those responses. Very well received. It's certainly been one of my burning questions, is who is going to be funding the justice elements and the impact dividend, as you called it, Catherine. I really like that phrase that you put on the table. And also a call for finance institutions and specifically development finance institutions to rethink their notion and conception of risk and what it means in the world that we're currently living in and one that we are moving towards. So what we're wanting to do is, we don't want this just to be a conversation that stops at COP. We want to be thinking about some next steps and beyond that. So we are very happy to have Christopher McGlade with us, who from the IEA, who is going to share some thoughts with us to stimulate some thinking around what can we do beyond COP27. So Christopher is going to share with us for about 10 to 15 minutes, and then we are going to start readying yourselves. I know there's some questions. No, you can't get Leslie to sign any documents today. Okay, so I know you all want to, but you might have some other questions that you want to pose. So get those ready and think about them and ruminate as well on what Christopher is going to be sharing with us. Thank you so much.
Thank you. Thank you very much for the opportunity to participate in this discussion today. Hopefully you can hear me. I can't really hear myself, but I'll lean in. Is that better? Yes, that sounds better. Just to say thank you again for the opportunity to speak with you. I would like to provide a few highlights and insights from a recent report that we released by the International Energy Agency, that we carried out in collaboration with the African Union Commission and the United Nations Economic Commission for Africa. And this report was called the Africa Energy Outlook. And it seeks to outline some of the key energy investments that are needed for Africa to fulfill its vision for itself in terms of a sustainable energy development. This includes universal energy access to all, as well as the nationally determined contributions and net zero targets that African countries have outlined. And this vision that we outline is called the Sustainable Africa Scenario. And really what its core aim is to be a useful aid for governments and investors, to provide an authoritative source to make sure that Africa's energy progress is at the center of this year's discussions around energy, around the climate. In our scenario, providing universal energy access to affordable energy is the immediate and absolute priority. Today, as we've been hearing, there are a very large number of people, around about 600 million people in Africa, who do not have access to electricity. Almost all of these are in sub-Saharan Africa. And to reach universal access to electricity by 2030, 90 million people need to gain access each year, on average, starting this year. Prior to the pandemic, prior to the current global energy crisis, 7 countries had come close to achieving the rates of progress that would be needed to be on track with this. Cote d'Ivoire, Gambia, Kenya, and Rwanda, there was all great progress. Unfortunately, because of the pandemic, because of the global energy crisis, there has been a real regression in recent years. Around the world, about 75 million people who had previously gained access to electricity unfortunately lost that because they could no longer afford to pay for it. Nearly all of those were in the continent of Africa. So what we need to do is turn things around as quickly as possible. And in our scenario, we outline a number of different ways in which this can be achieved. The key thing to bear in mind is it is not one solution that will work for every country or for all of the different populations that exist within each country. In particular, the solutions for urban environments are very different from rural environments. So of course, there is a role to be played by connecting houses to grids and powering those grids with renewable and low emission sources of generation. But also there is a role to be played by standalone and mini grid solutions. In addition to electricity, there is also around about 1 billion people who currently do not have access to clean cooking facilities. They rely upon dung, upon biomass in indoor fires for heating and cooking, and this has very adverse impacts on health. To make sure we achieve that goal of universal access to energy by 2030, 130 million people need to gain access every single year. Once again, unfortunately, there has been some regression because of the pandemic and the energy crisis. But in our scenario, again, we see a very rapid turnaround. About 1/3 of people gain access to clean cooking through using solid biomass in more advanced cook stoves. This is particularly important in rural areas so that we don't have to expand fuel supply markets to remote villages. They can use their existing fuel sources, but do it in a way that doesn't cause indoor or household air pollution. Another third gain access to clean cooking through liquefied petroleum gas. And then another third roughly through electricity, through biogas and through ethanol. And to put some numbers on this in terms of what it would require, really the levels of investment to achieve this for the 600 million people who don't have access to electricity, for the 1 billion people who don't have access to clean cooking, it would require $25 billion to be spent per year. That is not a lot of money. That is not a lot of investment that is required. Roughly speaking, it's equivalent to one LNG terminal, the full cost of that. Unfortunately, current investment levels are far below this. We're only investing around about 10% of the levels that are needed to achieve universal access by 2030. Ramping up access is going to require programs on the ground to mobilize to the large number of small projects that are required, which can be individually quite difficult to fund, to collectivize these so that we can start to mobilize the levels of capital at the scale that's required. Electricity is going to become the backbone of Africa's energy systems in the next decade in this sustainable scenario. New capacity is going to be dominated by renewables, particularly by solar. Solar is already the cheapest form of power in many parts of Africa. And by 2030, it outcompetes all other sources of generation. Africa is home to around about 60% of the world's global solar resources. But today, it only holds around about 1 to 2% of installed PV capacity. To put this in context, the amount of solar that is installed across the continent of Africa is less than the capacity that there is in the Netherlands today. The Netherlands is not a very sunny country. Africa has all of this huge potential. In our sustainable Africa scenario, we of course therefore see a huge increase in renewable capacity generation. Integrating this level of solar and wind in many locations will require improved flexibility, and it's important to assure consumers who can then start to increasingly rely on electricity for their energy needs. Africa's energy infrastructure requires a radical improvement, both in terms of the financial health of the public utilities and also regulatory changes that are needed to attract more private sector participation. Important progress has been made in this area in recent years, but this needs to be scaled. Structured tendering for renewables, for example, is proving particularly promising in areas like South Africa. And the cost of service electricity pricing reforms can really improve the financial health of utilities. Today, these sorts of reforms are under discussion or are already in place in 24 countries across the continent. For electricity, renewables are really going to be the way forward. But Africa's industrialization relies in part also on expanding natural gas use. Certain applications can't be met with electricity. For example, fertilizer production requires natural gas. If we can produce that natural gas domestically, produce that fertilizer domestically, it will improve food security. And also, another important area for natural gas is in industrial applications. We've been discussing the importance of creating new jobs and new industries. If we think about some of the heavy industries like steel manufacturing, like chemicals, these all require high temperature heat. It's the type of heat that electricity can really struggle to provide, but is much more easily provided by natural gas. In our scenario, from now to 2030, domestic demand accounts for around about 2/3 of Africa's natural gas production. But there's a lot of discussion I've been hearing across a number of discussions today around Africa development of natural gas. But I want to put that in context by looking at the right-hand side of the screen there. Today, there's been around about 5,000 billion cubic meters of gas that has been discovered in Africa. This is gas that hasn't yet been approved for development. If all of that natural gas was developed, it would, of course, lead to a slight increase in emissions. But today, Africa's contribution to cumulative CO2 emissions is around about 3% of the global total. If all of that natural gas were to be but has been discovered were to be developed, all of that 5,000 billion cubic meters were to be developed and to be combusted, that 3% would go to 3.5%. Basically a very, very small, almost minuscule increase in emissions. And this kind of brings us to some of the discussion around investment. Because while Africa accounts for around about 1/5 of the world's population, it attracts less than 5% of global energy investment. And achieving Africa's energy and climate goals will mean more than doubling energy investment this decade. This is a big change from the historic levels that we've been seeing. And in particular, why we need a doubling in total energy investment. For clean energy, we need to see a 6-fold increase by the end of this decade. This includes investment into things like renewables, but also into efficiency, into grids, and into access. This will require a change in the way that energy projects are financed. Again, we've been hearing some of this, but there's a role both to be played by public sources and by private sources. 60% of that investment that we see happening in 2030 comes from private sources of finance. Of course, there is a role to be played by public sources. In particular, public concessional finance can play a catalytic role in bringing down capital costs, especially as debt burdens increase and inflation drives up servicing costs. And there's a whole host of emerging best practices on how best to leverage the limited sources of finance that there currently are. We've been discussing a lot of that already. Technical assistance grants, guarantees, and increasing infrastructure investments from local capital providers will all play a role. But there's also a role here for international financial institutions. Those institutions need to have a mandate to boost investment into energy access, into clean energy investment, particularly in places where the cost of capital is very high. To put one more number on this, if we would look at a solar plant, the cost of capital for financing that solar plant in Africa today is around about 7 times higher than developing that solar plant in advanced economies. That 7-fold difference is really one of the reasons that we are not seeing the deployment of solar at the pace that is required to meet all of these goals. So that leads us to the question of where is this investment going to come from? There's multiple sources of finance that are relevant for Africa. There has been a lot of discussion around the $100 billion pledge from advanced economies. Of course, as we all know, advanced economies haven't achieved that level of finance. And what's more, of the 79 billion that they had pledged in 2019, only 7% of that went to Africa. So as with international concessional capital broadly, climate finance is well suited to expand beyond renewables projects to support those hard to commercialize activities and to de-risk new markets. But it's important that that sort of concessional capital doesn't do so while increasing country indebtedness. One area that we are highlighting here is that the finalization of the Article 6 of the Paris Agreement rulebook can really help to boost some of this investment going forwards. Of course, details for the implementation of the rules are still to be finalized, but it could generate up to around about $250 billion of financial flows to African countries by 2030, and significantly more than that thereafter. So just to finish, today's global energy crisis really has underscored the urgency as well as the benefits of an accelerated and major scale up in cheap and clean energy sources. This decade is critical, not only for climate action, but also for the foundational investments that will allow Africa to flourish in the decades to come. Thank you very much.
Thank you very much, Christopher, for those thoughts. Some interesting challenges for development finance institutions specifically, looking at credit enhancement, looking at very concessional finance. Earlier in the session, we heard that finance needs to be concessional, it needs to be catalytic, and it needs to be coherent. So that seems to be the 3 C's that we are talking about. So thank you very much for also reiterating that point. So I'm going to invite the panelists to join me once more. And we are now going to get to the part of the session where we are going to open up to questions from our audience, which has been following very closely. As I said, I've seen notes being very furiously scribbled as everyone has been talking. So don't be surprised if you are quoted on what you've said on this platform here today. So let's have a look. We will move the microphone around. So just hold on for the microphone so that everyone who's also watching both the live stream and the recording can hear your question. So just show of hands, any questions that you'd like to pose. If there's a specific panelist, please do address it to them. Or if it's a general or generic question, you may pose that. So any questions from anyone? Oh, thank you very much for the assistance. So there's one right over there. Maybe just if we could ask if you could just share your name and where you're from so that we can know who we're talking to. Thank you.
Thank you. My name is Dr. Vanessa Ndlovu from South Africa. So Iman was emphasizing a lot on what does a just energy transition mean, particularly for communities that are directly affected by this just energy transition. In South Africa, we have a very huge coal community. So what are we doing? What type of, do you guys have any plans? We know that we need about 98 billion in the next 5 years, according to the plan that the president shared with us. Do any of the institutions have plans in place? And what type of plans do you have in terms of addressing those communities, and how are they not going to get left behind during this just energy transition? Thank you.
Thanks for that question. I just want to find out, is there maybe another question so long, just while panelists get themselves ready to respond to that? There's another, we'll take, are the panelists happy we take 2 more questions and then we have a round of responses?
Hello, I'm Lamise Umarji. I'm a journalist from News 24. I was at an earlier session and I'm just a little confused. On one hand, there's a push for DFIs and MDBs to be less risk averse, but hearing what you guys, the DFIs, are saying, you're like, yes, we're the ones taking the risk. So I just need more clarity. Is it certain DFIs which are not taking risks, or just more clarity?
Thanks very much. So another question about the risk, and then we'll just take the last question.
Hi, my name is Monges Veti from Exaro, South Africa. The question I want to ask, it relates to SMEs in particular, especially that we're talking to the financiers here. In the context of just transition, how are the financiers going to create instruments that seeks to support small, medium enterprises in the endeavor to avoid leaving them behind as we transition, especially with our own fossil fuel energy in South Africa? How do we make those innovative finance means to assist them so that they are part of this transition? Thanks.
Thank you very much. So I'm just going to divvy up the questions quickly between the respondents. So I think the question around risk, I'm going to ask Catherine and Leslie, if you can respond to the question around DFIs and their appetite for risk. From the SMME perspective, I am going to ask Rion and maybe Ayan, if you could respond to the question around financing SMEs. I'll remind you of that. Christopher's off the hook in the immediate future for now, but just to ask who would like to respond to the question about, well, we are immediately facing coal-fired power stations being shut down. What is the plan and what is the investment plan around that was the first question. Anyone want to venture there? Okay.
I mean, as we know, South Africa is playing a leading role amongst the large coal-intensive economies in coming up with this just energy transition model. A lot rests on this outcome because there are many other countries, Indonesia, Vietnam, Brazil, India, looking at. There's a very sharp spotlight being shone on South Africa because of what happened in COP26 when the $8.5 billion was announced. There are several components to this, as we all know. The first component is phasing out at a much faster pace the coal-intensive energy grid. And that means bringing those coal-fired power stations to the end of their lifespan, and the New Development Bank and many other multilateral development banks stand ready to play a key role in that process. As I said earlier on, development institutions, because we are publicly owned, we are better stewards of public assets, and we would be better managers of decommissioning those coal assets. The second component we are already involved in a very aggressive way is rolling out and scaling up new renewable energy. We have invested hundreds of millions of dollars in the solar program, complementing all the other private power generators in South Africa. The third component, which is around, which is linked to this one, is around creating new industries, training and retraining of workers, stimulating entrepreneurship, especially in that Mpumalanga region, where the majority of the coal workers on the coal mines, coal logistics, coal-fired power stations, a huge concentration in that area. And this is where the country needs to have appropriate policies, appropriate support measures in place. As development banks, we are not necessarily we don't have the capacity to do that. We can only finance a project, and how, for example, the procurement is done. The country needs to give leadership to that, to ensure that there's job opportunities for young people, that it is not just all provided for big companies, as an example. In short, the components of the Just Energy Transition program in South Africa is very well codified. What we now need is the implementation plan for the different institutions to play their unique role within that space.
Thanks. So Leslie, again, reiterating that NDB is willing to buy up some of the coal-fired assets. I'm going to remember that if nobody else in this room does. So Catherine, maybe just some thoughts if you want to respond to the question of, or do you want to respond to that question specifically of the what is being done about the coal sector in South Africa?
Yes, I think you talked about the communities being affected. You talked about the, is it on? Okay. You talked about the communities being affected. The lady just in front of you is also from Eskom and is intimately involved in Priscilla, is intimately involved in how we are decommissioning plants as well as repurposing certain plants. I think it's important that we don't have a draconian model. We do not have a baseload in renewable energy yet. So what is important is that we look at how other people have done it. If you look at the Italian government, we have investment from Enel, the utility from Italy. They did not completely abandon the coal industry, although they are one of the biggest renewable energy investors, not only in South Africa, but in the world. They've got a large footprint. what they've done is they have repurposed a lot of the existing carbon intensive coal power plants, and have done quite a bit of work there to make sure that there's a balance as you ramp up renewable and start reducing your carbon footprint. In terms of communities themselves, you have to localize solutions. We're learning more and more that if you don't localize solutions and you ask the people on the ground who's lived with the problem, who already have ideas on how to solve the problem, if you don't engage them, it's probably going to fail, you know. The last point I wanted to mention is that we have a tendency, I guess, to take best practice, or what we see as best practice, and implementing it locally. We have to speak to the youth. There is a youth pavilion where a very interesting comment was made, was we have to recognize the voices of the future to make inputs today. And I think that is, we really need to start having confidence in what our young people can produce.
Thanks very much, Catherine. So I think Christopher has to run, although I've had many people saying, "Oh, can we get copies of the presentation?" So I'm sure we will arrange that. So thanks very much, Christopher. We really appreciate that input and giving us some food for thought. Thank you, especially if you even talked about how we prepare food on the African continent. So Ayana, I'm going to ask you to respond. There was a question. I appreciate you can't respond on behalf of all DFIs about who is risk averse and who wants to take on more risk, but maybe some more thoughts from your perspective on how risk averse should DFIs be, or how much more risk should you take on as a multilateral?
So I think unlike most DFIs, we were set up as a private-public partnership, and actually private sector banks own the majority of AFC. So that made us nimble. We are very high risk taker because we don't shy away from putting together a wind farm in Djibouti, looking at an industrial park in Nigeria, in Gabon. So we were set up to take that risk. So we do project development as part of our DNA. And we also have to really be very vigilant in how we manage the balance sheet so that we have the right rating to borrow internationally, so that we can go to the Japanese market, Korean market, and the Euro market. We haven't tapped the US market yet to do this in a responsible way. So when you talk about risk taking, I think one thing that is key, even though the base is small, Africa has one of the lowest project finance default rates in the world. Just Middle East is above us. So even though our projects have not defaulted, and because they are all African governments are paying through their nose to guarantee these PPAs and borrowing money to support that the private PPAs work, we have actually some of the lowest default risk. But there is a perception, there is an Africa risk premium that's attached globally, but it's not based on reality. It is based on a perception. The pricing models also do not advantage us. So I think in that context, there is a misconception of risk. Yes, we have political risk. So I think there are risks. These risks are political, by which you can buy insurance for. There's also currency risk, which we need to look at that because all our currencies are either pegged to the dollar or the euro. So the euro has been more stable. So those countries actually haven't seen devaluation. But if you look at all the large African countries, South Africa, Nigeria, which are a huge part of Africa's GDP, there's been a huge devaluation of their currency. So these are real risks that we haven't found solution to. But I think the perception of default is a misconstrued one, and that we need to correct as we go forward. But I think there is also there is a dislocation of capital. The suppliers are not giving money to the people that are doing the work, including some of the international DFIs, because you have credible players on the ground that are building 1.4 gigawatts, that are looking at adaptation, private sector adaptation. That money is not going in the right hands. And this is a fact. Sometimes they're competing with the local institution, and that should not be.
Thank you very much. And thank you for helping us as well about thinking about, especially talking about the perception of the African risk premium that is certainly quite pervasive in international finance. Rion, if I could ask you to respond to the questions, I know this is something specific that IDC looks at, is the question about how do we take SMEs on board? And I also just want to add to that, particularly as we think about some of these upstream opportunities in transition finance as well.
I'm very glad for the question, because we quite often think of decarbonization as the just transition. It is actually all about social inclusion, and it's about SME linkages. It's about the vulnerable communities and groups, and also the vulnerable sectors that need to be supported, like agriculture and tourism and those. So very much mechanisms need to be put in place. And again, we cannot go back to traditional finance models, because quite often it's a social enterprise that it's much better to solve a problem for a community. So therefore, in the IDC, we are experimenting with some funding towards social enterprises and the solidarity economy. So to see how one can optimally structure those type of enterprises. But very important is we started, for instance, with the SME linkage program, SME Connect, where we actively engage larger players in the just transition, and we see how we can provide access to market, access to finance, access to skills through a tripartite arrangement with a specific large player. And then I think another one, especially in the mining industry, is partnerships such as Impact Catalyst, which the different mining companies come together and they realize that they cannot decide on behalf of communities. They need to reach out, develop projects together with communities to make it fundable and bankable. So some of the type of solutions that we're looking at. Thanks.
Thank you. Really interesting. We're going to keep an eye on that social enterprise funding. I'm sure I see a couple of nods from the audience. So I just want to find out, is there one last burning question from the audience? As long as you don't have a coal-fired burning question, any other kind of question is fine. But thank you for the one person that laughed at that joke. Okay, so we're going to have one last question from Priscilla and a response, and then we'll have some very quick closing thoughts from the panelists.
So thank you. So it's a comment and a question. A comment, obviously, I always go back to practicalities of implementation because of what I do, sourcing funding, negotiating with all these banks around us. And I'm happy with all the radical ideas. We've been calling for reform on the financial institutions because when you negotiate prior the transition and after the transition, you know that it can't be business as usual. So definitely they cannot come with your conventional methods of funding that they were giving you prior the transition. So having commented on that, also in terms of the credit enhancement, the de-risking, very exciting because that is a missing link, you know, in terms of practically now. So it's what they offer and what we have to tap onto. But the question then is, and a challenge, not just a question, for them to consider result-based modalities where the funding, you know, linked to the transition milestones so that they support holistically, you know, funding, not just cherry picking, but if you give a corporate sort of loan or sustainable linked loan that is based on results, and are they keen on that? So that's a question and a challenge.
Thanks very much for that, Priscilla. And I think that question can actually be the closing thought from each of our panelists. So what is your response to either a results-based, you called it impact investing a little bit earlier, Catherine. So just your thoughts in closing on this session. I'm going to start with Ayan, and then I'm going to move to my left. So your thoughts on, from your perspective, AFC's approach to, is this something that you can do? Can you have milestone-driven investments where there is either a punitive or an incentive perhaps that's linked to that.
I think this question is best addressed. I don't have the money to do that because I have to service my debt. I have to provide returns to my shareholders. I don't have that because we are a private-public partnership. But I think that's a very important question for the concessional world, where we should be getting ourselves, DBSA and others, money that should come to us with results-based framework. And that if the results are delivered, then we can get the incentive to us. So for that purpose, I think this is more important for the concessional finance providers as opposed to us that are looking at this. So I don't have the free money to do that.
I think that was a very useful starting point to address the very key issue that Priscilla has raised. As I mentioned earlier on, there is currently a significant sort of revision taking place within the multilateral development banks about how to solve that problem. It's very important to highlight, as you have just touched on, that the concessional piece is also climate philanthropy, which is a growing area within the climate domain. Then there's the traditional development finance institutions like the World Bank, Africa Development Bank, ourselves, and so on. And then you have the big institutional investors and your commercial banks. I think one of the key points to make is that as an individual institution, New Development Bank or Africa Development Bank would not on their own embark on, let's say, a structure working with ESCOM to design a solution. It has to be syndicated across the development finance system. So we would be very willing to participate alongside the other DFIs to look at the South Africa the decarbonization program, and to look at which components, the riskier parts, can we, for example, take on, as I mentioned earlier on. The second key point that I'd like to make is that one of the innovations that is likely going to happen in the next 6 months or so is the World Bank and your big concessional financiers will come up with a climate window. At the moment you have, when I say climate window, I mean a window of financing. The World Bank has a what's called IDA, which is the concessional lending arm. And then they've got your traditional commercial lending arm to finance infrastructure. There is discussion underway to create a climate change window, which is a new modality of financing, because as you know, climate change also crosses borders. So when you address, for example, the carbon problem in Mpumalanga, there's Mozambique, the surrounding countries. So the model of development banks is very much focused on sovereign guarantees. You want a guarantee from a single government, and that is no longer appropriate. This model was designed 77 years ago at the Bretton Woods conference in New Hampshire after the end of the Second World War, when the World Bank was formed. To this day, that is the model that is in place. The challenges we deal with today, whether it be global pandemics, whether it's climate change, across national or transnational in nature. We need to look beyond the single country guarantee model. So in the World Bank, they are designing something right now and thinking through what would such a climate change financing window look like, and how can they bring in other institutions into syndicate structures to solve that problem. I don't have the answer, but people are thinking through this in a very intense way at the moment.
Yes, it's a difficult one, but for, I think, development banks, and I'm going to, let me not generalize, for the DBSA specifically, because we've been in that space, that ambidextrous space of development upstream work, as well as lending, expecting a return business model, our assessment of risk is a little bit different. So we're going up the risk curve as we go towards what you're talking about, and we are not uncomfortable with it. What we are not ready for yet is to provide ourselves with a model that speaks to that, so that as we lend into sustainability instruments, you can see these are the tried and tested impact dividends that come from that. We are doing it to some degree, but it's not that well developed. Philanthropic money, which is what Leslie mentioned, lends itself to that, because when they give you money, in order to ensure that they don't necessarily always want a return on the money, but they want to see the development impact of that money and what the results come from that. So developing a model around that, creating an opportunity to fund projects based on a type of carbon exchange. If you look at Eskom itself, the more we fund into either repurposing or decommissioning your plants, and you start expanding into sort of more greener assets, funding that expansion through a carbon exchange is one way. You know, we'll give you capital if you prove that in 3 years this plant has reduced carbon emissions by X, etc. Doing that kind of exchange or that sustainability model is useful, but it's very, very early stages and something we're extremely interested in. I mean, specifically from a project prep perspective, something that we are very, very interested, an instrument that we'd like to develop as well. So, and of course, the ESG bonds, the sustainability bonds, we've already done a few, but looking more and more into how the focus can be completely on sustainability dividends and monitoring those for our investors. Thank you.
We have different DFIs, and IDC is a specific focus DFI that focus on industrialization. Energy and infrastructure is clearly an enabler. And therefore we would look at, we do investments in energy and infrastructure, and we will look at new models of investment. But we also want to play a part specifically in the automotive and the hydrogen economies. We know the automotive sector employ as much people as the coal mining sector, and they are at risk given the restrictions on our exports. So there are challenges, and we need to find solutions for hydrogen, for automotive, as well as for the energy component in order to implement this great plan of ours. Thanks.
Thanks very much. So in a nutshell, Priscilla, still a challenge that stands, I think, to all of the DFIs who gave the responses. And I want to thank all of our panelists today. So Ayan from AFC, thank you very much for joining us. Leslie from New Development Bank, thank you very much. Catherine from DBSA, and also DBSA as the host of this particular event. We appreciate it. And Rian from IDC, and in his absence, Christopher from the International Energy Agency. If you have any other questions, maybe you'll be lucky enough to grab the panelists immediately after this. Thank you very much to the panelists, to the audience, and to everyone watching the live stream. Thank you.